Hello, welcome back. We're gonna take a look at the subscriber recommended company. This one is Qorvo, as you'll see here, and the sector is technology and semiconductors pretty much. As you will see, if you're not aware of this company, it develops and commercializes technologies and products for wireless and wired connectivity worldwide. And it's an interesting one. It seems like it's moving quite a lot compared to the overall market, 37% more, in fact. And it's an old IPO, 1997 here, a US company. But let's take a look at what is going on with this company's financials and whether it's a potentially nice opportunity here for us to add to a portfolio. Now it's down almost 50%, as you'll see. It has been completely battered down with the rest of the market, but overall it has gained through the years, and you'll see that it had its massive high somewhere around July 2021 or so, and right now it's actually sitting much lower at about $105. But let's examine the financials because that is what we care about really. You will see that the PE ratio of the company is sitting at 10.6 here, and that's obviously super good. It's a pretty low PE ratio, and also the price to free cash flow ratio also pretty low, 13.2 here. Outstanding shares, the company has been buying back shares, which seems to be making sense because the stock looks pretty cheap right here, and you can already see that most of the signs are green here, which I like to see. Now, free cash flow to total liabilities, and another one which is nice. It looks like the company is making good free cash flow when you compare it to the liabilities that it has. We'll examine the details in the financial statements, of course, as we usually do. But the 5-year revenue growth has been nice. It has been increasing for the company. Maybe not tremendously, but still increasing, so upwards trajectory. But take a look at this 5-year net income growth from almost negative territory here, actually, in fact, negative territory, to very positive territory. So the company is doing better and better, and I love to see that. And when companies enter profitability, I actually like to be around, especially when this happens in the early days. And so free cash flow growth also increasing here. Total equity growth slightly going down a little bit, but okay, this is probably not a huge factor. I'm assuming the company may have gotten a little bit of extra debt, we'll see. But the debt to equity ratio is actually fairly low here, and the current ratio is very high as well, which points to a company that's very solvent. Good net income margins here, about 25%. Good return on equity, very good, 24%. And yeah, everything about the company looks good so far. Do we have any news? Let's examine whether we have any news about the company. Not for the most part. It's like revenue surprises of 6% and 1% respectively. Not much really happening. It's just being discussed a little bit as a deeply discounted stock. Interesting. The company is not paying any dividends, but we do want to examine some details about their income statement. Before we do so, let's see if we have any price targets here for the company. So implied moves tend to be higher, and the price targets are 135, 145, even 245 over here. An insane move. So people are generally suggesting that the company should be around 150 to 200 here. Very interesting. Okay, so let's go back to our financial statements. And we will see that the revenue of the company, as I talked about it earlier, it is increasing, but not massively. Still increasing nicely. And the net income from negative territory to very positive territory, and I love to see that, of course, and getting some nice earnings per share. Okay, what about the balance sheet? Now over here you will see that the total equity of the company is about the same that it was back in 2017 really. It's actually even a little bit lower. So it looks like the company hasn't been increasing their total equity here. You will see that they have been increasing their total liabilities quite some with their total assets, and while they still have positive total equity, it doesn't increase that much. Is an interesting thing to see. Now that's not necessarily a big problem as long as the company is making cash flow. We'll examine that. The net income has been increasing, as you'll see, we talked about it again, 1.3 billion in terms of net cash provided by operating activities here. And if we take a look at investing, is negative. The company is investing a little bit, mostly in PPE, good thing to see, in capital expenditures. Okay, very normal stuff. What about their financing activities? Now over here you will see that the company is actually buying back some stock, which is nice to see, of course, and also still getting a little bit of extra debt over here. And the cash that they have right now is actually in their all-time high, 1.4 billion. Also nice to see. And take a look at this one, 200 million for free cash flow back in 2017. Right now sitting at 1.1 billion. If we take a look at the balance sheet again, their total liabilities were 2.5 billion, meaning that what we saw over here in our original, stock analysis chart over here and the metrics, you will see that it takes about 2.3 years for the company if they really wanted to pay back their debt, their total liabilities, that is, not even just the debt. So this is amazing. This is really good. Now, everything looks great in terms of the company financials, but we do want to examine what kind of price to pay for this company. And again, we're going to be using our stock evaluation tool, our trust evaluation tool here, and project what the company is going to be doing in the next few years. So based on what has been happening in the last few years in terms of revenue growth, I think we should go something like maybe 3, 5, and 7% in terms of the revenue growth here. And the net income margins that we're going to be doing, you see that they're getting better and better. We're going to go somewhere in between. Let's go like 8, 10, and 12 here. And the free cash flow margins, again, we need to be looking at the positive ones for the most part. And they are probably going to be going down as the company is generating a little bit more revenue. I'm going to typically want to be using something like 80, 90, and 100% in terms of the margin that gets converted to free cash flow. And an annual return of 13% is what I typically want to be making out of my stocks. Again, I can make 10% with an ETF for the most part, so I want to be making more out of a stock. This is why I'm using 13%. I have more risk out of a single stock. Let's hit calculate. And when we do that, we see that based on the current price, we are still a little bit more elevated than what I'd like to see. It didn't look like it, but if you actually compare it to what the company has been generating and their margins so far, we are still a little bit far from what I'd like to see. We can potentially go a little bit higher in terms of the free cash flow margin and try that out. Let's just go 100, 110, and 120. But I'm pretty sure we're still going to be in red territory here. So we need an important increase in terms of what the company has been doing financially in terms of their margins, or maybe a decrease in the current price, which is probably easier. And so as it is right now, I think I would want this stock to go much, much lower than it is in order for me to consider buying it. And you can get a little bit fooled from what you have seen here in terms of the PE ratio and the price to free cash flow ratio. But the thing is, we want to be examining what price to pay based on what the company is projecting to be doing in the future. And this revenue growth seems to be stalling things a little bit, because even though it's rather low, it's at rather low levels, it hasn't been increasing that much. And so we're probably looking at a company that's going to remain stagnant for a little while, unless there is some sort of boom in the revenue growth, which you can potentially project, but it may never happen. And so for these reasons, I think I would like to get a much better price from this company if I were to invest in this one. But hope that gives you an idea about Qorvo. Good company, but we need a better price in order to enter this one. And thank you for watching the video. I hope you enjoyed this one. And please leave a like if you did, and remember to subscribe. If you want also, you can get access to this tool, unlimited access, by becoming a Patreon. You can find links in the description box below if you're interested. And thank you for watching this one. I'll see you in the very next one. Bye bye.